Welcome to this explainer. Today we're going to unpack a super comprehensive guide on a topic that is quite literally the foundation of every single successful enterprise out there: how businesses actually fuel their growth. Whether you're an aspiring entrepreneur, a business student, or just someone fascinated by the sheer mechanics of commerce, understanding where the money comes from is absolutely crucial. We're going to break down the complex world of business finance to make these concepts really stick. Okay, let's jump straight into our roadmap for today. We're breaking this down into 6 clear steps: lifeblood of any business, classifying business funds, tapping into internal sources, borrowing from external sources, raising capital through shares, and finally, choosing your funding strategy. Section 1. The lifeblood of any business. Why funds matter. I absolutely love this quote from the source material. Finance, therefore, is called the lifeblood of any business. Think about it. A business literally exists to produce and distribute goods and services, right? Without capital, that whole circulatory system just stops dead. You can't buy materials, you definitely can't pay your staff, and honestly, you can't even keep the lights on. To really ground this, I want you to meet Mr. Anil Singh. So Anil runs this highly successful restaurant. The food is a total hit, and now he wants to expand into a whole chain. But there's a catch. His personal funds? Just not enough. His dad suggests bringing in a partner, but Anil is super hesitant to give up control or share those profits. Plus, he's kind of terrified of taking on massive bank loans, so he's confused. Keep Anil in the back of your mind as we go through this, because everything we're about to cover is exactly what he needs to figure this out. Right, so Anil's very first task is to figure out exactly what he needs the cash for. Businesses generally have 2 main buckets for financial needs. First up, fixed capital requirements. This is the long-term stuff. For Anil, we're talking about buying real estate, heavy-duty commercial ovens, dining furniture. That money stays locked up for years. The second bucket is working capital requirements. This is your day-to-day survival money: buying fresh veggies, paying the waitstaff, covering the monthly rent. The exact mix of these two, well, that depends entirely on the size and nature of your specific business. Moving on to Section 2, classifying business funds, making sense of the options. So how do we organize this chaotic world of funding options? We can actually map them out in 3 main ways. First, by period. Are we talking long-term, medium-term, or short-term? Second, by ownership. Are these owners' funds where you hand over a slice of the pie, or are they borrowed funds where you simply owe a debt? And third, by generation. Are you looking inward at internal sources or outward at external ones? Having this mental matrix really helps cut through the noise when you're evaluating your choices. Let's zoom in on that ownership piece for a second. Owners' funds are, well, exactly what they sound like: money provided by the owners. The huge takeaway here is that this is permanent capital. It stays in the business forever. But here is the critical part for our guy, Anil. Providing owners' capital is what gives you the right to control the management. If Anil brings in new owners to get their money, he automatically dilutes his own control. It's a massive trade-off. All right, Section 3, tapping into internal sources, self-financing your growth. The absolute classic internal source is retained earnings. Think of it like this: when a company turns a profit, it doesn't actually have to hand all that cash back to the owners as dividends. It can hold on to a chunk of it to fuel future growth. You'll often hear this called plowing back profits. Since Anil's current restaurant is already doing great, he could, theoretically, just use the profits he's making right now to slowly build out his new locations. But of course, there's always a catch. Let's look at the merits first. It's fantastic because it's self-financing, no interest costs whatsoever, and Anil gets to stay 100% the boss. The limitations, though, it's highly uncertain. Profits naturally fluctuate, right? If the restaurant has a slow month, the expansion basically grinds to a halt. Plus, if you have multiple shareholders, hoarding all the profits instead of paying out dividends can make people pretty unhappy. Which brings us to Section 4, borrowing from external sources, looking outside the business. If Anil's own retained earnings aren't going to cut it for a speedy expansion, he's got to look outward. Let's quickly run through some key external tools. For short-term needs, you've got trade credit, basically buying ingredients now and paying your supplier later. Then there's factoring, which is where a financial service buys your unpaid customer bills at a discount to give you cash right now. For longer-term stuff, commercial banks offer term loans, though we know Anil's a bit anxious about those. And finally, lease financing, renting your fixed assets like ovens or delivery vans for a monthly fee instead of buying them outright. Now, I want to highlight a massive external borrowing tool, debentures. A debenture is essentially a formal long-term IOU issued by the company. It's a formal instrument for raising long-term debt, explicitly acknowledging that the company has borrowed money and is legally promising to pay it back with a fixed rate of interest. Understanding the characteristics of debentures is super important for making a strategic choice. When you issue a debenture, those investors become your creditors, not owners. That means Anil's control of the restaurant, totally protected. Plus, the interest you pay on debentures is actually tax deductible, which is a really sweet financial perk. But, and this is a big but, those fixed interest payments are mandatory. Even if Anil's new chain hits a massive slump and loses money, he legally still has to pay out interest. No exceptions. Okay, Section 5. Raising capital through shares, selling ownership. So if Anil incorporates, he can issue shares. But not all shares are created equal. Let's look at the two main flavors. Equity shares represent true core ownership. These folks take on the highest risk because there's absolutely no assured dividend. If the company makes zero profit, they get zero cash. But the flip side, they get voting rights to actually steer the company. Preference shares are a bit different. They come with a fixed dividend rate, and they actually get paid out before the equity shareholders do. Much safer for the investor, but usually they don't come with the same voting rights, so less dilution of control for the original founder. This comparison right here is absolutely vital. If you only remember one thing from this explainer, let it be this fundamental difference between taking on new owners versus taking on debt. Shares mean ownership. You're paying dividends out of your profit, and those payments are not tax deductible. Debentures mean creditor status. You're paying mandatory, fixed interest, but it is tax deductible. It really is the ultimate balancing act in business finance. And finally, Section 6, choosing your funding strategy, making the final call. Look, as our source material makes super clear, there is no magical, perfect source of funds. Choosing the right path means weighing some very specific factors. What's the purpose and the time period? Remember, fixed assets need long-term cash, daily operations need short-term. What about cost and risk? Debt has fixed, mandatory risk, while equity is safer for your cash flow but costs you a piece of your company. What's the impact on control? Equity dilutes it, debt doesn't. And what are the tax benefits? You really have to measure all of these against the current reality of your specific business. So, let's bring it all the way back to where we started. Put yourself in Anil's shoes for a second. Looking at all these structured options we've unpacked today, would you sacrifice a degree of your control by issuing equity, just to make sure you can expand safely without the stress of mandatory loan payments? Or would you take on the fixed, legal risk of debentures to ensure you remain the sole, uncontested boss of your entire restaurant empire? I want you to really think about that. Apply the frameworks we covered today and try to make a decision for them. Thanks so much for joining me for this explainer. Keep analyzing those options, and I'll catch you next time.